Hi, honey.
Uh-oh. Hello? Oops. Okay. Could you hear me okay? Okay, guys. We're going to get started in chapter 6, which is revenue recognition. I don't believe I'm going to cover the whole chapter. I've modified the exercises a little bit. And when you go in and go into your chapter 6 folders, you'll see chapter 6 exercises, do these or something like this, complete these. You'll see 2 sets of them. I had to recreate the exercises because 1 or 2 students had already started working on the original ones. So I wanted to leave those out there so they could complete them if they want. But please make sure, and you know what, I could show you instead of me just talking about it. Keep forgetting I could do that, so you can see what I'm, when you go into Learn, let me share my screen with you so you can see that. So when you're in Learn and you go into 212 and you go into chapter 6, and it's not going to look exactly like this, but you will see practice exercises, correct version. This is the version you want to do. This one is out here, but it's for those who had already started. And I think there's 1 or 2 people. So please do that version of the chapter 6. Because as I said, in chapter 6, we're going to definitely get through part A of the chapter and part C of the chapter. B, hit and miss. I'm gonna talk about some things, but not all of them. So today we're definitely getting through A and maybe starting part C. Now, what pages are we talking about? 277 is where part A starts, and it goes to 287. Then part C begins in 304. So between 287 and 304, I'm going to pick certain things out to talk about. Okay, so I encourage you to read all of it and try to understand it to the best of your ability. Listen to my complete voice lecture on it. But for our purposes, for what you're going to be responsible for then, I guess it would be the final exam, this is the areas you want to focus on the most. Okay, because we could spend 2 or 3 weeks talking about revenue recognition. Revenue recognition, a whole chapter on how to recognize revenue. Why do we have this? Because they changed it. For many, many years, all we did in accounting is we said record revenue when it is earned. But now the FASB, in conjunction with, accountants and the public, said we need to get more specific with revenue recognition. And that's what this chapter covers. So this is a very new standard. Well, just to review, revenues, remember, are inflows or other enhancements of assets of an entity or settlements of its liabilities. So revenues are either cash coming in, accounts receivables being owed, or notes receivables being owed, enhancement of assets, settlement of its liabilities. So somebody paid us early and now we're doing the service, a combination of them. So they try to hit all the different things from delivering or producing goods. That's one way you can earn revenue, rendering services, or other activities that constitute the entity's ongoing major or central operations. So that's our accounting definition of revenues. The important thing about revenues is that we measure and we report them correctly. So it is important not only to determine how much revenue to recognize, or how much to credit the revenue account for, but when do we recognize it? And that's what this standard, that's a whole chapter long basically, tells us. And it really runs through all the different types of scenarios that could happen. Whoops. Now, there we go. In part A, we're going to look at it from a general perspective and what most companies will deal with. Part B goes into special areas of this principle. And really not everybody's going to have the different scenarios they throw at you. That's why I kind of leave that to last. If we have time to go back to it, we will. Prior GAAP, before this new revenue recognition principle came out, said this: the realization principle required that revenue be recognized when the earnings process is virtually complete. So you've provided the product, you've provided the service, and you feel pretty confident, reasonable certainty that you're going to collect the asset. So whether it be money or some other form of payment, that's when you recorded the revenue. But there's a problem with that. The revenue recognition principle is poorly tied to the FASB's conceptual framework. Remember that framework we learned back in like chapter 1? The focus on the earnings process led to similar transactions being treated differently in different industries. And this recognition principle made it difficult to apply to complex arrangements that involve multiple goods or services. So they're just telling you the why we don't follow this very generic principle any longer. So this is our new, oh my gosh, it's 6 years old already. I thought it came out like last year. The new revenue recognition standard says this, or this is what happened. In 2014, it came out. It provides a unified approach that replaces more than 200 different pieces of specialized guidance that had developed over time in US GAAP for when to recognize revenue under various industries and circumstances. So what this is saying is that we, over time, different industries have different ways of determining when to recognize revenue. Over 200 different approaches basically were being done and were allowed. Now with this standard, not anymore. Now we all follow one rule. And it's not that simple. It's not just, it's a rule, okay? But it is one guidance. And everybody's not out here doing their thing and their thing and their thing. So that's what this accomplishes. Here's the core principle of it. Companies recognize revenue when goods or services are transferred to customers for the amount the company expects to receive in exchange for those goods and services. When do we record it? Upon transfer. How much? How much we're entitled to receive. And if you're like, that's kind of like what we were just talking about. No, here's how we determine those. There's 5 steps now to revenue recognition. Now, some of this is pretty straightforward in our day-to-day operations. We could just go right through the first 5, through these 5 and be like, okay, we know, because when we sell, we could identify everything there very quickly. But it's in these more complex transactions that these 5 steps are necessary. And that's really what part B deals with, some complex, weird things that can happen. And this guides us on how and when to record them and how much. So we're going to be identifying, this is your first step, identify the contract, the transaction. Okay. That's first. The second thing, we're going to go through each of these. Identify what we call the performance obligation. We're going to talk about that. Determine the transaction price. Allocate it if we have to. And recognize revenue when or as each of these things we identified up in number 2 happens or is satisfied in the contract. So these are always our 5 steps. And it's a good idea just to write them down and have them there, because you need to do these 5 steps now when recognizing revenue, or prove that you did them. So, whoops, I'm seeing a chat. Okay, hold on, let me, come on. For deferred revenue, yes, when you're trying to decide if you should recognize it. So Hyro asked, do you still go through these steps for deferred revenue? Absolutely. So you want to make sure, and you're going to see that. So first, these steps are going to tell us if we should call it deferred revenue, and then when to remove it out of the deferred revenue. So I think we're going to see that over the next few slides. So hang in there. And if not, we'll take you to the book. Whoops. Go backwards, sorry. Okay, so again, here's what we're doing. We identified the contract. The contract could be, there's always a contract in a transaction, whether it's an assumed verbal or it's a legally written down. But what we're really doing here is looking at the legal rights of the seller and customer. Then we identify the performance obligation. There could be one thing. One thing could be, we sold a coffee cup to a customer. That's how simple it could be. Identify the contract, the sale between the customer and us, and we sold them a coffee cup. So that's identifying it. There could be multiple performance obligations in a contract. We're going to look at this more. In this contract, we're going to sell you a photocopier and also a maintenance contract to perform maintenance on this over a 3-year period. So now you have more than one thing happening in a contract. So we need to identify those things. So first, identify the contract, then identify what's happening. What is the responsibility of the seller in this? What's the performance obligation? Then we're going to determine the transaction price overall. So if it's a single, it's the amount the seller is entitled to receive from the customer. We're selling the coffee cup for $1 to the customer. If it's multiple, again, the amount the seller is entitled to receive from the customer must be identified. So that's all we're doing there. We're not saying how much goes towards the photocopier or the maintenance contract there. Nope, not yet. That's in step 4. So you can see these are very defined, precise process. And some of them will just happen all together. The next step is allocate the transaction price. Well, if it's a single selling a coffee cup, there is no allocation between performance obligations. But when you have one contract that says we will provide you with a photocopier and a maintenance contract for $10,000, ooh, we're doing 2 things. We're selling you a product and we're providing a service, 2 performance obligations. Now we've got to take that $10,000 and determine how much revenue is associated with the photocopier and how much is associated with that performance contract we just sold to you. So that's where we have to now start allocating the transaction. Then recognize revenue, or as each performance obligation is satisfied. So if we're selling a coffee cup, when the transaction is complete, when we provide the coffee cup, the buyer takes ownership. If it's over a period of time, there's your deferred revenue. We'll recognize it over a period of time. Multiple. Now, this is where that photocopier and maintenance contract is really important. So you allocate the dollar amount to each. How much revenue is associated with selling the photocopier? How much revenue is associated with that maintenance contract? Okay. Well, when we sell the photocopier, we record revenue, but we won't record revenue on that maintenance contract until time passes and we've performed that obligation. Okay. 1 second, guys, okay? Okay, sorry about that. Okay, so let's start taking a look at these in more detail. So we got an overview. So recognizing revenue at a single point. What are we looking at here? Indicators are used to determine when control, so title, transfers from the seller to the customer. A customer is more likely to control a good or service if the customer has these things. Obligation to pay for it. If they didn't pay for it yet, they do have an obligation to. They have the title to the asset, so they could use that asset as collateral on a loan, or they could sell that asset. They have physical possession of it as well. So just because you have legal title doesn't mean you have physical possession. Remember, when you're selling inventory, we have FOB destination and FOB shipping point, okay? But if you have legal title to it because it was shipped FOB shipping point buyer, remember, buyer takes ownership as soon as it gets on that truck. Now we have a recognition of revenue on the seller side. Assumes the risks and rewards of ownership and has accepted the asset. So these are the things we're looking at to determine, did a sale, did this control happen? So let's take a look. TrueTech Industries sells the TriBox, a gaming console. It allows users to play video games individually or in multiplayer environments over the internet. A TriBox is only a gaming module and includes no other goods or services. When should TrueTech recognize revenue for the following sale of 1,000 TriBoxes to comp stores? So it's like your, I don't know what the latest and greatest internet thing is. Oh, Clarence. My dog just hit his head on my desk. But it's a gaming system and it's a physical gaming console. Okay. So on December 20th, Comp Store orders 1,000 TriBoxes at a price of $240 each, promising payment within 30 days after delivery. So the order occurs on December 20th. There's no entry. All that is occurring on TrueTech is only, sorry, I let my dog out now, ordering or selling. They're taking an order. TrueTech is only taking an order here. Comp Store is placing the order. There's no control being taken over by Comp Stores yet. January 1st, TrueTech actually delivers the 1,000 try boxes to comp stores. And title, there we go, title to the try boxes transfers to comp stores. And if you're like, well, that's the way we've always done it. Right. So a lot of this, you'll be like, we already do it that way. You are correct. So it's on the day the title transfers, TrueTech will debit accounts receivable for $240 times the 1,000 try boxes and credit sales revenue. Then when they receive the money, when TrueTech pays it, I'm sorry, when comp stores pays TrueTech, they'll debit cash and credit accounts receivable, just as we always have. So like I said, a lot of this will be pretty normal. This standard was created to grab all the crazy things people are doing out there and try to put them so that they have one set of guidance for people who just sell coffee cups one at a time, or they're only selling coffee cups, or they're only selling try boxes. It's going to be pretty normal, the accounting as we've always known it. What happens though if revenue is recognized over a period of time? Now, when would that occur? The customer consumes the benefit of the seller's work as it is performed. So, a cleaning service. Okay. The customer controls the asset as it is created. So we would recognize, and we're going to see this in Part C, revenue being recognized over time if the customer controls the asset as the seller is creating it or building it, like constructing a building extension. So your customer already has a building and the contractor is building an addition on it. Well, that customer still has control as the of that new extension because it's on their original building. The seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payments for progress to date. Okay, so again, that's in Part C. We'll see that more. An order of jets customized for the U.S. Air Force is an example of when we would recognize revenue over a period of time. So if any of these criteria are met for our performance obligation, what we're selling, then we recognize revenue over a period of time. It will be recognized, the revenue, in proportion to the amount of the performance obligation, so that activity that has been satisfied. So that's our guidance. Let's look at an example. TrueTech Industries sells 1-year subscriptions to the TriNet multi-user platform of internet-based games. So TriNet was just, or TriBox in our last example was the council, just the system. Now this is different. Now they're selling subscriptions to this multi-user platform of internet-based games. So if you want to use your TriBox, basically, you got to buy the subscription to the internet-based games. Here's how TrueTech sells these: 1,000 subscriptions for $60 each on January 1, 2021. So here you go, Hiro. Here's your deferred revenue. So the question is, January 1, did they do any performance obligation here? Did they satisfy this? And the answer is no. They just received the cash. So we debit cash at TrueTech, credit deferred revenue for the $60,000. At the end of each of the 12 months following the sale, since a month passes, TrueTech should then debit deferred revenue and recognize service revenue equal to $5,000. 12 months on this contract, just like we've always seen, right? we'll recognize the part of the cash we received upfront as revenue as the subscription period expires, because that's when we completed the service. Then, by the end of 12 months, all 60,000 will be recognized as revenue properly. Are there any questions? So that's kind of what we're used to already. What happens though if a performance obligation doesn't meet any of the 3 criteria for recognizing revenue over time? So remember those 3 criteria. I'm just going to go back. Give me a second, one more. There we go. There's your 3 criteria. So if it doesn't meet, revenue is recognized at the point in time when the obligation has been completed. When is that? Usually at the end of the contract. And you'll see later in part 3, we could refer to this as a completed contract criteria. Now, how can we recognize, like say we're talking about that construction of the addition. How do we know, like the subscriptions was pretty straightforward. You're going to use up, you're going to have a 12-month subscription. So we could base the revenue recognition on time. But how can we determine how much revenue to recognize as we're building an addition onto a building or building a jet for the US Air Force? What they do is a seller needs to estimate progress towards completion. Now, how can they do that? And you're going to see it in action maybe later today, definitely Thursday. We can measure as the proportion of the goods or service already transferred to date. So we're supposed to send out 10,000 coffee cups. We've sent out 6,000. Okay. Input-based estimate is measured as a proportion of effort already expended thus far, not expended thus far, but measured as the proportion of effort expended already relative to the total effort expected. So that's pretty generic, huh? You'll see. We have to determine some kind of measurement that we could define in our completion. So if we're building an addition, maybe we ask ourselves, how much do we expect to spend? What's the expected expense? As the person building it, as the company building it, we're the seller here. What should we expect to spend over time to build this addition? Let's say it's $500,000. I'm just jotting that down. Then we say, well, how much did we spend already? What was the effort already expended to this point? Well, we've already spent $200,000. Well, if we divide that, it already has cost us 40% of the total cost. So we could look at that as 40% of this project is complete. So we should recognize 40% of the revenue. So that's what they mean by input-based estimate. You're going to see that in action. So that's how we would determine how much revenue to recognize. Now, let's kick it up a notch here. What happens how do we recognize revenue for contracts that contain these multiple performance obligations? And you see the two red, and that's what I pointed out to you when we were looking at that graphic. If we suspect a contract has more than one activity or performance obligation, the seller has to do more than one thing. Steps 2 and 4 of the revenue recognition process comes into play. First, we identify the contract. We see, what do we have to do? What does the seller have to do? What are the rights of each? What are the activities of the seller? Is it one, or is there more than one in this contract? What's the total transaction price? Now allocate that transaction price to each obligation and then recognize revenue either at a point in time or over time, as we just talked about. Now, number 2, sellers account for a promise. So the performance obligation, sellers must account for a promise to provide a good or service as a performance obligation if the good or service is distinct from other goods or services in the contract. So we must separate goods and services that are distinct in the contract. Now, what determines if something is distinct? It's capable of being distinct. So that just means it could be separated and stand alone. For instance, the photocopier, the maintenance contract. Can that maintenance contract be sold separately? Absolutely. So it can stand by itself. It needs to be separately identifiable from other goods or services in the contract. Okay, and again, here's the photocopier, here's the maintenance. So let's go back to TrueTech here, because TrueTech has this situation, but let's look at the contract in this scenario. They manufactured their TriBox system, multiple gaming system, allows players to compete with each other over the internet. Now the scenario is this. The TriBox system includes the physical module, and also included is a 1-year subscription for that multi-user platform of games. TrueTech sells individual 1-year subscriptions for people who already own these at $60 each. So if you bought it separately, it would be $60. The modules that are sold are $240. So you can just buy a module without this 1-year subscription for $240. But if you buy both together, $250 is the selling price. So on January 1, TrueTech delivers 1,000 TriBox systems to comp stores at a price of $250 per system. So now the TriBox system includes a 1-year subscription. TrueTech receives $250,000 from comp stores on January 25th, 2021. So the question is, well, we sold them the $250,000, $1,000. We got $250,000 of revenue, or do we? So now you'll see this 5-step process really be important. First of all, do we have a contract? Absolutely. We're selling to a buyer. Are there separate performance obligations? Absolutely. A good or service is distinct, remember, if it is both capable of being distinct and separately identifiable from other goods or services. And we have that here. TriBox module, TriNet subscriptions. And we already know they are sold separately. So there's 2 performance obligations of TriNet or TrueTech. TrueTech has to satisfy 2 things here. Okay. What's the transaction price? Well, it's $250,000. We sold 250 systems to comp store, whatever it's called, at $1,000 system. But how much should be recorded as revenue? Well, first of all, before you even decide that, we need to separate that $250,000 between how much should be allocated to the box itself and how much should be allocated to the subscriptions. So the transaction price, $250. The standalone price of the module is $240. Remember, you bought that box separately, $240. You bought the subscription separately, $60. So just like any other time we have to allocate, we say, how much would we have paid in total if we bought these separately? Or I'm saying it, I shouldn't say buy. If we had sold these separately, let's take it from, because we're the ones recording the revenue. If we had sold these separately, we would have received $300 in revenue. We're not selling them separately. We're selling them together as one system for $250. So if we had sold them separately though, of the total $240 in revenue we would have received from TriBox sales, divided by the total sales, they would have made up 80% of the total revenue we would have received if sold separately. Take the $60 for the TriNet subscriptions, divide that by the total standalone revenue of $240 plus 60. So 20% of the revenue would have been associated with the subscriptions. That's how we'll divide the transaction price or allocate it. 80% of the $250 is allocated to the revenue for the TriBox module. $50 or 20% of the $250 total revenue transaction price is allocated to the TriNet subscriptions. So all we're doing here is allocating how much of that total revenue for both performance obligations should be separated and allocated to each performance obligation. Are there any questions on that? Now, when do we recognize the revenue? Two performance obligations. Let's look at each one separately. First of all, the TrueTech sells the TriBox module itself to CompStore. CompStore takes ownership of that on January 1. Title is transferred, but just for that part, just for that performance obligation. So sales revenue of $200,000, the part that is for the TriBox modules, should be recognized as revenue. The $50,000 associated with the subscriptions or has been allocated as the subscriptions amount is deferred revenue. That didn't happen yet. We didn't provide that performance obligation yet. Yeah, that will be provided over the next 12 months by TrueTech. So not all of this is revenue, but we will debit accounts receivable because CompStore must pay the whole $250,000 in cash, but $50,000 of it is deferred revenue. Are there any questions on that? So now you can see these 5 steps and why they're so important. Now, as each month, at the end of each month, TrueTech will recognize revenue related to that month's subscription. So they'll debit deferred revenue for the $50,000 divided by 12. So the total revenue allocated to that performance obligation divided by the time the performance obligation will be satisfied. So 4167 is debited to deferred revenue. Service revenue is credited each month. And you could see the T account there. So by the end of the year, all 50,000 will be recorded. But the day of the sale occurs, do not call it revenue because you did not satisfy that performance obligation. Recognize it over time. So now you can see the reasoning that we have these 5 steps. So just to review it with you one more time. First, we must identify a contract. So a contract, remember, establishes legal rights and obligations of the seller and customer with respect to one or more performance obligation. Then identify the performance obligation. It could be one or it could be a few. So a performance obligation is a promise to transfer a good or service that is distinct, which is the case if the good or service is both capable of being distinct and can be separately identified. If it can't, then it's not a separate obligation. Next, determine the total transaction price. What is that? The amount the seller is entitled to receive from the customer overall. Then allocate it. Allocate it between the different performance obligations you identified up in part 2. How much revenue is for this performance obligation? How much of the transaction price should be revenue for this performance obligation, or as many as you have? So they will allocate that price based on the relative standalone selling prices. So if you're like, well, what if you don't have a standalone? You should, because in part 2, you're saying, I do have a distinct product or service, and you should be able to determine a selling price if you just sold that product or that service. Then allocate based on the standalone selling prices on that ratio we just talked about. Once you determine how much transaction price should be allocated to each obligation, now recognize revenue based on when that service or product is being complete and performed. So if it's the seller recognizes revenue at a single point in time, what guides you there? There's an obligation to pay the seller. The buyer takes title. They take possession of the asset. They assume risks and rewards of ownership. They accept the asset. I'll answer you in a second. I see your question, Hyra. Let me just finish my thought here, and then we can talk about that. The seller recognizes revenue over a period of time if customer consumes benefit as work is performed, customer controls the asset as it's created, or the seller is creating an asset that has no alternative use. Now, Hyra's question is, so in the case, there's more than one type of subscription, let's say $5 for a month, $10 for 2 months, etc. Do we put them in separate deferred revenue accounts? That is really up to you. But you need to be able to track the revenue that is earned each month based on that subscription amount. So some companies will create different deferred revenue accounts so that they can track it better. Some may just have one deferred revenue and create a schedule, a supplemental schedule that tracks the details, but you have to do some type of tracking. Remember, your general ledger accounts are yours. They're internal to the company. So you can get as detailed and specific with tracking in those general ledger accounts as you want. You have to have at least a deferred revenue account, because in the end, when you provide your external information, your financial statements, you're going to combine all those into one account anyway on your balance sheet. So it's really up to you. Does that answer your question? Cool. Good question. Okay. All right. So now I'm not going to go through this. That's the part A. That's the overview of this new standard and the steps we have to take to recognize revenue. Now in part B, as I said, it gets into some weird things. Like what kind of weird things could happen in step 1? that you're not used to? What kind of weird things could happen in step 2 or 3 or 4 or 5? And it gives us guidance. So these are our special issues. We'll come back to those. What I'm going to do is go to our slides for part C. And I'm actually, and it's called Accounting for Long-Term Contracts. Okay, let me see what they have there. No, okay. So this is beginning on page 304. So I'd like to get us through, okay, we have about a half an hour, through the general information related to accounting for what we call long-term contracts. So in our part A, we looked at probably the norm, okay? Selling a product or selling a service and how we recognize revenue. Part C could be considered a special industry guidance, but it is important for you to understand it because it's tested on the CPA exam, okay? And it is important for revenue recognition. What is it? This guidance is for companies who earn revenue, so they perform obligations on long-term contracts. What are we talking about here? If you take a look at page 304, okay, Oracle, the creation of computer software, okay, that could be a long-term contract. License and consulting obligations could be on long-term contracts. So these companies hire, these companies sell computer software on long-term contracts. Lockheed Martin, they sell aircrafts, missiles, spacecraft that they create, okay? And the creation of it is long-term. It takes them a long time. It's not something that happens in a month. Hewlett-Packard, information technology, they may be creating and selling. Northrop Grumman, shipbuilding. So a customer hires them to build a ship. That's what they sell. Commercial and KB Homes, they sell homes. It doesn't take 2 months to build a home or a commercial building. It could take over a year, maybe sometimes 2 years. Maybe they build bridges, okay? So these are companies that are creating a product or a service on a long-term basis. So the question comes in, when the heck do you recognize the revenue if you're creating something on a long-term basis? So again, you have to identify the contract. Step 2 is a big thing. Usually in these types of contracts, there could be more than one, or usually you have a single performance obligation because other things don't meet separately identifiable criteria necessary for the different goods and services identified in the contract to be a distinct item. They are items that can only be presented as a group or together. So that's the good news. You only usually have one obligation. The other thing that comes up with, because we only have one obligation, one transaction price, one amount of revenue to recognize. We don't need to allocate. But step 5 is when, and that's the key here. Remember what it said before. If you can't, and let me see if I could find that slide. multiple. Sorry, let me get there. That's not what I wanted. Hold on, I'll find the slide. Okay, here it is. If you cannot have your obligation go into one of these criteria. So you recognize revenue over a period of time if the customer consumes the benefit of your work as you're doing it. Sorry about that. My son got a flat tire. Okay. The customer controls the asset as it is created. So you should recognize revenue over the time, seller, or the seller is creating an asset that there's no alternative use. So it's a special order. Then you as the seller should recognize revenue over time. If it doesn't meet any of these, then wait till the contract is done to recognize all the revenue. So keeping that in mind, now let's go back to long-term contracts. So it becomes, when do we recognize revenue? Well, you may have to recognize it over the time that you're completing it because it meets one of those 3 criteria, or you wait till it's completed because it doesn't meet one of those 3 criteria. So it really depends on the contracts. So let's see how we do recognize revenue. That's a lot of stuff there. We'll break it down. It gives us everything at once. But normally you would know 2021. You would know 1 year at a time there. Here's our scenario. The beginning of 2021, Harding Construction Company received a contract to build an office building for $5 million. So here's the seller, Harding. They're going to receive revenue in total of $5 million. I'm just going to jot that down. So you remember, $5 million is the revenue to Harding. They will construct the building according to the specifications provided by the buyer, and it's going to take 3 years to complete. According to the contract, Harding will bill the buyer in installments over the construction period according to a pre-arranged schedule. Information related to this contract is as follows. So this is just setting up the scenario. Now, we would need to know this stuff in order to complete our journal entry information each year related to this project. So just so that we could record actual financial transactions, buying materials, billing the customer. We're not going to wait till the end of 3 years and send a bill out for $5 million. No, we're going to start billing them over time. So in 2021, here's what happened. They paid, Harding Construction, paid for construction costs, materials, labor, overhead of building this office building, $1.5 million. We expect to pay an additional $2.2 million, $2.250. So we expect over the life of the contract, building this office building, we're going to have to pay $3,750,000 in costs. We're charging the customer $5 million. That's a nice little profit. We billed the customer during 2021, $1.2 million, and they sent us $1 million in cash. To look at 2022 in the same respect. How much did we spend to construct the building in 2022? $1 million. Last year's costs were 1.5. So far, we have spent 2.5 million to construct the office building. We expect to spend another 1.5. So now our costs are a little bit higher. And that could happen just because price went up, we estimated incorrectly, anything. So now the costs are at $4 million. That's what we expect in total. Sorry. Okay. How much did we bill on this contract during 2022? Well, we sent a bill out to the customer for $2 million, and they've sent us in another $1.4 million. 2023. Now we looked and said, how much did we pay for stuff during that year? So these are actuals. We spent 1.6. So far, we've spent actually 2.5. So through the end of this contract, we have spent a total of $4.1 million. So back in when we first started, we thought it would total about 3.750. We were wrong. Actual came in at 4.1. The contract is complete. We finished the construction, so there's no more future cost expected. We billed the remaining 1.8 million of the 5 million, so 1.2 plus 2 million was 3.2. Remember, our revenue on this is 5 million, so we're going to bill out that remaining 1.8, and our customer paid us the balance they owed us during the year of 2.6. When the heck do we recognize revenue? So keep this in mind. Even if you're jotting some stuff down, I'll flip back and forth the best I can. Let's take a look. First of all, we always stick with what we know. Now, where did this come from? Let me see if they have this. They have this same example in your book on page 305. So you can use that also to help you determine where these journal entries came from. 3 journal entries we always have to do before we even record the revenue. And these are each year. We debit an inventory asset account. This is an inventory asset account called construction in progress. We debit that for the actual costs spent during the year. Remember, we're building an office building here. We're building the asset we're selling. This is inventory to us. So as we build it, we should debit an inventory account called construction in progress. Credit, it'll be cash or materials. I'm not too concerned about the credit, but essentially that's where the stuff came from that we used. So in 2021, it'll be 1.5 million. We need to record the amount we billed the customer of the $5 million we're charging them. We'll debit accounts receivable. But instead of crediting revenue like we normally do, we credit a contra to construction in progress. So billings on construction contract is a contra account to the construction in progress account above. Hold on one second, okay, guys? Thank you. Sorry. Okay. So now we credit, not revenue, because we haven't decided how much revenue should be recognized on this contract. We just know we billed. So we store any amount we billed in this billing on construction contract, which is a contra account to the construction in progress. So when we report the construction in progress on our balance sheet, remember it's an inventory account, we're going to subtract the part that was billed in that billings on construction contract. Then we record the amount of cash received by debiting cash and credit accounts receivable, because that's how much we received from the customer of the 1.2 billion or million we have billed them for. We do the same journal entries for 2022 and 2023's amounts, but we'll wait till that year to actually do them. So that information is the actual information from the project. The amount, the costs that we've used in the year is the first journal entry. The amount we billed in the first year is the second, and the amount of cash we collected on those billings is the third. Now, how much revenue do we show in each year? All right, here's how we determine it. There's two major ways. The first is wait till the whole contract is done and then record all the revenue in the end of the third year. We call that the completed contract method. So if this contract doesn't meet one of those three criteria I showed you before, this will be your journal entry right here. This should be a debit to construction in progress, a debit to cost of construction, and a credit to revenue from long-term contracts. Okay, so you would debit construction in progress once at the end of the project. You will debit the cost of construction. Cost of construction is cost of goods sold on your income statement. Revenue is the total revenue, of course, that will be on your income statement. So if you're going, well, that 900,000, isn't that the gross profit? Yes. And you always debit the gross profit amount in your journal entry to the inventory construction in progress account. And I don't think we'll have time. We might. I'll show you the T accounts. What's our other option? What we call percentage of completion. We will recognize the revenue a little bit each year as the contract is completed. Now, let me show you that. And here's how we determine it. This is the formula to determine how much revenue should be recognized or recorded each year. What we do is we say, how much of the project is completed to date? 60%, 50%, 40%. We'll show you how to figure that out. Multiply the percent that's completed to date by the total revenue, which is on your contract. 5 million is the total revenue. Here's how much of the project is completed. What this tells us is the amount of revenue that should be recognized by that date. So it's not how much revenue to recognize that year, it's how much revenue should be recognized by the date you're doing this computation. So if you're going, well, what do you mean? Well, if you've recognized any revenue already on the contract, it needs to be subtracted from this first computation. That will give you the amount you should recognize just this year. So you need to see this in action. So let's take a look. First of all, we use the input method for determining how much revenue should be recognized. And I kind of went over this a little bit with you back in the beginning of class. We are going to use how much costs we have incurred on the project to determine how much revenue should be recognized on the project that year. In year 1, 2021, we have incurred actual costs of 1.5 million. They give us that. Now, to determine how much cost percentage-wise we have incurred by the end of year 1, we need to know how much cost we expect to incur on the entire project at the end of year 1. And this will change, but the best information we have at the end of year 1 is we are going to spend a total of $3,250,000 $750,000 on this project. So far, we've spent 1.5 million. So divide that out. So cost-wise, we've completed 40% of this project. Well, if that's the case, we should recognize 40% of the total revenue because 40% of this project is completed. This is the first year we're recognizing any revenue. So $2 million is the amount of revenue that should be recognized this year. Are there any questions? Take a look at the second year. The second year, we had actual costs of 1 million. To date, by the end of year 2, we have actual costs of 2.5, 1.5 last year, 1 million this year. We look at our estimate. How much do we expect to spend next year on materials to finish up this project? Another 1.5 million. So as of the end of year 2, we have better numbers. Our total estimate of costs is at 4 million. So we say, well, what percentage of the project do we have done as of the end of year 2 based on this information? We have total actual costs of 2.5, total expected costs of 4 million. So 62.5% of the project is complete by the end of year 2. Now you got to be careful here. So that means by the end of year 2, we should recognize a total of 62.5% of the $5 million as revenue, or a total of $3,125,000. So popular today. We've already recognized 2 million. You got to keep that in mind. So we'll see that. So at the end of year 2, we're not going to recognize a total of 3,125,000. We're not going to recognize that amount, I should say, this year. We're going to recognize the part we haven't recognized. By the end of year 3, total costs, actual costs are now 4.1 million. There's no more costs to go. We're done. So we've spent 4.1 million. We expected to cost, and it did cost 4.1 million. So by the end of year 5, we are 100% done with this project. So by the end of year 5, we should recognize all 5 million. Take us to the next page. So at the end of year 1, recognize 2 million, none has been recognized. So in 2021, we are going to credit revenue from long-term contracts, 2 million. We debit under the percentage of completion, this method, the cost of goods sold account basically, which we call cost of construction, but it is an expense account that goes on the income statement for the actual costs this year, 1.5 million. The difference is debited to construction in progress, that inventory account. It's a plug. So this is a credit and these two are debits. Let's take a look now at 2022. There it is. By the end of 2022, we should recognize 3,125,000. We've already recognized 2 million of it. So this year's revenue will be 1,125,000. Credit revenue from long-term contracts, 1,125,000. Where does that 1 million come from? Right here. The actual costs we paid for this year are debited to cost of construction. The difference is debited to the construction in progress account. Sorry, geez. Okay. Now, final year. So this is your final journal entry. Do those other 3 we talked about. Then record the revenue portion and the costs into the expense, cost of construction. Final year. we need to recognize $5 million by the end. We've already recognized $3,125,000 of it. $2 million last year, $1,125,000, or I'm sorry, $2 million in 2 years ago, $1,125,000 last year. So the remaining $1,875,000 will be credited to revenue from long-term contracts this year. The actual costs we paid for this year will be debited to our cost of construction expense account. The difference is debited to construction in progress. Crazy, right? Now, here's your journal entries. And this is really important for you to understand what's happening here. Because I remember going, well, that's a gross profit right here in this journal entry. Why are we putting that in construction in progress? Because there's nowhere else to put it. And we need the journal entry to balance. And there's something else that occurs. If you go to these journal entries that are on page 306 of your book, so all the journal entries we just did, the top is the first three. Take a look at when you debit construction in progress, right here, 1.5 million. That's the actual cost of construction. And you credit billings on construction in contract, which is your contra account. In the percentage of completion, you also debit construction in progress, or really the portion of gross profit you recognized that year. Now you get an ending balance. So what are these two really? This is how much of the contract you should have billed out by the end of 2021. The 2 million right here. You only billed out 1.2 million. So you're going to net these two on your balance sheet. And we'll show you that probably on Thursday. In year 2, there's the debit to construction in progress for the actual costs you paid for materials. There's the debit for right here, the 125,000. Add these three numbers together. So by the end of 2022, it says you should have billed out a total of $3,125,000. How much did you actually bill out? Well, the billings during 2022, that account was credited for 2 million. You billed out more than you really should have. Oh, well. So we billed out 3,200,000. Really, we should have only billed out 3,125,000. During 2023, actual costs were 1,600,000. Gross profit recognized was 275. So by the end of 2023, we should have billed out $5 million. That's really what we're keeping track of in there. How much did we bill out? Well, we completed the additional billings of 1.8 in 2023, crediting the billings on construction contract, and we billed out 5 million. So over time, these accounts will be different, but at the end, they'll have the same but opposite balances. And we actually close them out to each other. At the end of this construction progress, the asset's gone. We've been collecting the cost and gross profit we've been recognizing in the inventory account. It's gone. We're done billing. We've recognized all this as revenue. So we're going to debit the billing on construction contract and credit the CIP account, construction in progress, and get them off our books. So in the end, those two accounts go away, where they're just active during construction. Okay, so I wanted to get through that one with you. Let me see if there's anything else I wanted to go back to here. All right, now it's just showing you. Okay, it's just showing you in this slide that I skipped how much revenue. In both situations, you recognize the same amount of revenue, whatever the contract is. Percentage of completion, you're going to recognize a portion of it each year based on how much you've completed using the costs of the project. Completed contract, you just wait till the end, recognize all of it as revenue and all the gross profit related to that contract in 2023. Of course, the FASB loves us to do this. But if our contract doesn't fit into one of those 3 criteria, we have to use the completed contract method. Okay, so I know I kind of went right to the end, but I think you guys are in pretty good shape with this chapter actually. On Thursday, when we come back, we're going to go back into it and look at some funky things that could happen related to contracts. In this scenario, every year we had a gross profit. Our costs were always less than our revenues. Everything was good. But what happens if we start getting into loss situations? Okay, so that's where I'm going to end our discussion today. Do you guys have any kind of questions for me? All right, well, thank you so much for attending, and I will see you both, and hopefully more of you, on Thursday to finish up talking about chapter 6. Have a great day, guys.